there are three different phases in the circular flow of national income, that is production, income and expenditure. Production of goods and services is required to meet the unlimited human wants and desires of the society, and it is the combined efforts of four factors of production such as land, labor, capital and enterprise by which the flow of goods and services come into existence. In the process of production, income is generated, which is further distributed among different factors of production in the form of money income, such as rent, wages, interest, and profit for rendering their services. Such income is further spent on final consumption and forms aggregate expenditure. Thus, production generates income, income gives rise to demand for goods and services, and demand in turn generates expenditure, and again expenditure leads to further production. In this way, a regular circular flow of production, income and expenditure continues, and it has neither any beginning nor any end. And national income is an aggregate of flow of this production, or aggregate flow of income, or aggregate flow of expenditure. This is already explained in a previous module in the circular flow of income. Now we are going to discuss how national income is calculated through three methods. They are value added method or product method, income method and expenditure method. In this module, I am going to explain the value added method or product method. What are the steps involved in the measurement of national income by value added method? Classification of productive enterprises into primary sector, secondary sector and tertiary sector. Primary sector and secondary sector produces goods and tertiary sector produces services. Primary sector produces goods by using natural resources like land, water, minerals, etc. It includes all the agricultural and allied activities like fishing, forestry, mining and quarrying. This sector provides raw materials to secondary and tertiary sector for producing goods and services. Secondary sector is known as manufacturing sector. This sector transforms one good into another by creating more utility by using men, machines and materials. It includes manufacturing units, small scale units, large firms and multinational corporations. For example, manufacturing of steel by mixing carbon and iron, and then sugar from sugarcane. All these are examples for secondary sector. Tertiary sector provides services like banking, insurance, transport, communication, trade, commerce, etc. And this service is rendered to primary and secondary sectors. After the classification, we have to find out the net value added by each and every sector. How can we find it out? First of all, we have to calculate price into quantity of the commodities produced by each and every sector. That is value of output. From that, we have to deduct intermediate cost or intermediate consumption. Then we have to deduct depreciation and net indirect tax. So we will get domestic income or NDP at factor cost. To that, we have to add net factor income from abroad. Then we will get national income. Before the calculation, we will see what are the precautions to be taken while measuring national income by value added method. And how can we avoid double counting in this system? What are the precautions? First of all, sale and purchase of second-hand goods should not be included because these second-hand goods, their value were already counted in the year in which they were produced. That is in another accounting year. But the commission and brokerage involved with such goods should be included because they are newly generated income. So, that money is to be the money value of all the final goods and services only to be calculated, to be counted. That is the market value or money value of all the final goods and services produced in that particular accounting year. Which is accounting year? It is starting from the 1st of April of a year to the 31st of March of the following year. So, the market value of only the final goods and services are to be taken. The value of second-hand goods should not be included. Then, the value of goods produced for self-consumption is included. But the production of services for self-consumption is not included. For example, a mother teaching a child at home. So that service for self-consumption, it is not included. Because these services are produced and consumed at home and never enter the marketplace, that is why they are called a non-market transaction. Now, what is the problem of double counting? According to output method of calculating national income, value of only final goods and services produced by all the production units of a country during a year should be counted. In other words, value of intermediate goods which enter into final goods. For example, sugar used in biscuit, raw cotton used in garments, wheat used in making bread, etc. should not be taken into account. We take into account only the value of biscuit, garment and bread, which is the final good. And what is double counting? It means counting of the value of the same product more than once. And this can happen because goods go through several stages of assembly before they find their way to the intended buyer. As the original goods goes into different processes and passes through many stages, there is always a danger that its value may be included at every stage and result may be double, triple or manifold counting. In the given example, you can see the different stages of value added. The farmer sells to the flour mill for 10,000 rupees. That is the value of output, price into quantity. Value of intermediate consumption is taken as 0. So value added is 10,000. Value of output minus intermediate consumption, 10,000. Flour mill sells it to baker for 15,000. What is the value added? Only 5,000. Then baker sells to consumers for 18,000. So what is the value added here? 3,000. So the total value added is only 18,000. But if at every stage we count the value of output 10,000 plus 15,000 plus 18,000, what is the answer? We get an exaggerated value of the final goods and services produced. That is why we are not taking the value of intermediate product. When the farmer sells to flour mill, 10,000 is the value added. Flour mill sells to baker, only 5,000 is the value added. And baker sells to consumers, only 3,000 is the value added. The other 15,000 or 10,000, they are the intermediate cost. So 10,000 plus 5,000 plus 3,000, 18,000 is the value added. This is one approach to the value added method of measuring national income. Now we will see its detailed format, that is product method. Value added method or a product method. So what is product method? National income is the total money value of all the final goods and services produced by a country during an accounting year. How is it calculated? National income by value added method is equal to, or NNP at factor cost, or national income is equal to sales plus change in stock minus intermediate consumption minus depreciation minus net indirect tax plus NFIA. Sales plus change in stock. What is change in stock? Closing stock minus opening stock. So each and every term I will explain after this. Sales plus change in stock, we get value of output. Minus intermediate consumption, we get value added or GDP at a market price. Minus depreciation, we get NDP at market price. Minus net indirect tax, we get domestic income or NDP at factor cost. Plus NFIA, we get national income. So, in my previous modules, operating surplus, compensation of employees, income method, value added method, I have already explained the meaning of these terms, intermediate consumption, depreciation, net indirect taxes. But while calculating national income, I will explain it once more. So, according to product method, sales plus change in stock is equal to value of output. Change in stock is equal to closing stock minus opening stock. We get GDP at market price. That is sales plus change in stock minus intermediate consumption, we get gross value added. That is gross value added at market price or GDP, gross domestic product at market price. In order to get domestic income or NDP at factor cost, net domestic product at factor cost, we have to deduct depreciation from GDP at market price. When we deduct net indirect taxes, that is indirect tax minus subsidy, that is net indirect tax, we get domestic income or NDP at factor cost. To that, we have to add net factor income from abroad. We get national income or NNP at factor cost. Kindly refer my previous modules where I have explained each and every term. What is GDP at market price? What is depreciation? What is net indirect tax? What are the components of NFIA? All these are explained in detail. So, the link will be given below. Kindly refer it.